Good afternoon, and thank you for joining us as we discuss trends, risks, and operational hurdles when structuring evergreen and private credit funds. I am Matthew DiBrienza. I'm an audit partner at Withum with over 25 years of experience working with fund managers across all asset classes and focusing on closed-ended private equity funds and private credit managers. Today with me, I have Heather Wyckoff. Heather is a partner in Alston and Bird's New York office, working with investment managers of all asset classes. Michael von Bevern is co-founder of Symposium and is now part of Suntera Global, an independent global provider of fund administration, corporate, and wealth management services. Michael, Heather, thank you for joining us today, and introduce yourselves as well. We can then jump right in.
Thanks, Matthew. We're excited to chat, and thanks for having us.
Yeah, thanks, Matthew.
So thank you for sharing your expertise and experiences with us today. Michael, we'll jump right into the first question. So over the past few years, we've seen really a growth in the evergreen fund structure, specifically around private credit strategies. In your opinion and experience, sort of what is driving, where we are today? What's driving this trend? Where's the LP demand coming from? And sort of what does the last few years look like and how we got to where we are today?
Fantastic question. Loaded answer. A lot of factors go into that answer. But the last couple of years, we've seen a shift from closed-end credit funds to more evergreen structured credit funds. Just evergreen is where, investors are, seeing returns on a risk-adjusted basis that are very attractive. I have clients that are at like a net 15% plus IRR, on private credit. And you also see the attractive ability, for liquidity, and you also see the attractiveness of the cash flow. So there's a lot to like, about evergreen credit. And like I said, over the last couple of years, it's been a shift since closed-end credit, where it was really driven by direct lending, which sort of works in the closed-ended space, given its sort of bulleted maturities, to where now the umbrella of private credit has really expanded beyond direct lending. So today we're seeing an increase in other strategies beyond direct lending. One of them being specialty finance, which offers really attractive evergreen characteristics, where it's offering more stable cash flow, and it's more self-amortizing, which lends itself to the liquidity, for an evergreen fund.
I think there's a lot of perceived advantages from the manager's perspective as well. It's another tool in the sort of fundraising toolbox where private credit lends itself nicely to both a closed-end format and an open-end format, because they're sort of a well-worn set of mechanisms you can use to create liquidity without the need to liquidate assets ahead of when you would otherwise be selling them in accordance with the fund's business plan. You can accommodate investor liquidity because there's a natural runoff to those credit investments, where you can use the sort of repayment of the debt in order to match out sort of withdrawing investors who roll off in a queue very nicely without disrupting the portfolio or the manager's ability to make new investments. And so it's attractive to LPs, as Michael mentioned. It's also something that's been attractive for our fund manager clients. They can also structure closed-end funds and open-end funds that kind of invest in the same type of strategy. It gives them a lot of flexibility and optionality. And I think when you cross over into the sort of retail distribution side, you see an increased interest in launching things like BDCs or interval funds to explore retail distribution, the mass affluent channel. And those products themselves are, largely liquid funds with very limited sort of redemption windows in order to accommodate an illiquid asset class in an open-end format. And so some of what you see on the evergreen private credit side, on the private fund side, is actually tying into similar type of program being pursued by the same managers alongside or on a retail distribution channel, as well as access to these types of strategies expands.
Where do you see the sectors have changed over the past few years? Meaning, where fund managers are spending their time, are there more, a renewed focus in certain sectors where you're seeing funds apply their private credit evergreen strategies, or has that sort of evolved over the past few years as well?
Well, I think Michael touched on this a bit, where, with your traditional sort of closed-end direct lending strategies, now there's all sorts of really interesting products coming to market with the specialty finance, different types of asset classes. And there's sort of an expansion of different types of strategies that are being offered, whether it's more opportunistic in general in a broader program, or something really tailored to a specific thing like music royalties, or some type of sort of really specialized thing that lends itself well to a securitizations.
Yeah, I would say I would add that over the last year. I mean, NAV financing has been popular. Infrastructure financing, alternative real estate, financing. Banks have tightened, their credit profile, and funds have stepped in. And, given the returns and the desire for, the liquidity, it just makes sense. It's just come together nicely. And it's probably the most popular fund structure we have seen over the last 6 months, and continue to, talk with, potential customers or existing customers about.
Yeah, one of the things Michael mentioned, I mean, you could see with the sort of rise of AI puts demand on sort of, in for real estate specifically, rise in data center construction. Data centers themselves are, traditionally something that's financed with like securitizations instead of just a traditional mortgage type of financing. And so there's all sorts of interesting opportunities that correlate to trends we're seeing in the broader market that are being picked up by private credit funds.
Yeah, I appreciate that. What types of structures do you see being in demand? Meaning, do you see LPs looking to access private credit through, I'll say, commingled funds, SPVs, co-investment? Where have you seen the demand, from LPs on that side?
Yes.
Yes, yeah, right. I think I mean, it's obviously, so the manager's goal is generally to create like a blind pool commingled vehicle. Co-investments are a popular fundraising tool as a carrot for investors, but also as a way to introduce yourself to a third party co-investor who may not yet be ready to provide a manager with full discretion and wants more control on a deal by deal basis. There's a rise in sort of these fundless sponsors doing deals like on a one-off basis, and using that as a precursor to rolling things up into a fund. Um, but I think there's any number of different formats that these relationships can take.
100%. I think the format's really driven by the manager and the type of investor they're going after. Um, I mean, there's nothing too revolutionary here. Master feeders are still, a popular structure, standalone funds, co-invest. Um, I will say I've seen more done on the fee side recently with regards to tranching out management fees for different classes of investors, and putting in more sort of promote structures through the carried interest, where GPs are rewarded for better performance. You know, let's say under 12% IRR, it's one percentage, and for carried interest, and then over 12 and maybe over 15, it gets even better. So you see that. But the structures themselves have stayed the same, and they're all tools in these toolboxes as they attract investors.
Thank you for that, Heather. So when you're working with fund managers looking to launch their fund, what are some of the formation items that you discuss with them in terms of structural differences between your traditional closed-ended fund versus your evergreen structure in private credit, whether it be liquidity, compliance, et cetera? Sort of what is the things
Yeah.
that are top of mind?
I mean, two things come to mind. Liquidity, how do you manage that being the most important thing for any kind of evergreen fund when the underlying asset class is illiquid? How do you design the terms so that the manager can continue to manage the portfolio for the non-redeemers, but yet satisfy the redemptions as people submit them without disrupting the portfolio. So there's a pretty well-worn way of doing that in a private credit fund where you essentially take a snapshot of the loans that people participate in when they put their hand up and say, I want to redeem. They don't participate then after they submit that request in new loans that are being made after they put themselves in that redemption queue. And then as the principal and interest gets repaid on the loans that they do participate in that withdrawal snapshot, those proceeds get sent out to them and they satisfy that redemption. Those investors continue to participate in P&L and pay fees and expenses while they're in the redemption queue. And therefore, I haven't locked in a NAV on their redemption date the way I would in a hedge fund without the ability to then promptly kind of sell assets to pay the redemption. Instead, I'm relying on that natural repayment of the investments in the queue to match out those redeemers. And if there is an impairment on a loan, the fact that they continue to participate in P&L will account for that. They'll just receive less as the proceeds flow back to them. There can be like nuances to that. The manager may have the ability to make a cleanup kind of offer or payout, sort of take back like small redemptions in order to clean up what's in the redemption queue. But that's the sort of basic vanilla way of handling the liquidity. And then as far as your compliance question, I think one of the most key factors if you're launching an evergreen fund, but you have closed-end funds, really comes down to allocation, making sure that your allocation policy has enough flexibility for you to appropriately ramp up or wind down your closed-end products while maintaining your evergreen fund that's kind of perpetually in its investment period, but also has flexibility to deal with, the redemption queue or like new subscriptions that are coming in. So you can't just be making investments pro rata based on available cash. There has to be some flexibility to vary what you're allocating to your open-end funds or your closed-end funds in the structure so that both of them are kind of operating properly in accordance with what each of those buckets of investors has expected.
Michael, on the fund administration side of all of that, it sounds like there's additional complications. So sort of how do you approach it from the administration side and technology changes and things of that nature that sort of manage all ends of this, right? From the LP side, and the asset side from a cash flow and allocation perspective.
Yeah, it's a good point. I mean, technology is key to us delivering, the right service to private credit funds. Having loan administration platforms that handle each of the different facilities, the contracts under those facilities, being able to show our clients, amortization schedules, OID schedules, things like that, are really table stakes, for us to be, a private credit fund administrator. So we've invested heavily and worked with, what we think are some of the best partners in the tech side. We use tried and true on the allocation side, systems that have been around there for a long time. But on the portfolio side, I've tried to stay current with, the ever evolving, changing technology space on private credit. It is competitive now. It used to not be, which is good. And the tools for us are really important because we also provide loan agency services. So having a borrower portal and a lender portal in addition to an LP portal, is important in private credit, if you're going to be in the agency or sub-agency space. So yeah, the structures themselves aren't necessarily the concern. It's really just meeting all the demands for information, and notice generation and things like that, which, are really important, especially to our clients who are in the sort of middle market lending space. There's a high level of customization that our lenders want to have with their borrowers, and I want to be able to deliver on that. This is a very customized business. And so for me, being able to work with them and get them what they need so, they're successful and, Obviously, if they're successful with their borrowers, they'll be repeat borrowers. If they're successful with their lenders, they'll be repeat lenders. And so we sit somewhere in the middle trying to make all that happen for them.
Sounds like a daily challenge, but exciting. So we think, Heather, you mentioned earlier on about retail coming into private credit. Sort of what have you seen in that space? You know, there's a lot out there about insurance company appetite for rated feeders and other types of structures to
Right.
enter the space to kind of match their cash flow needs with the returns. Sort of where have you seen, you know, sort of that evolution recently?
Yeah, I mean, those are sort of two separate concepts, right? So you have your insurance companies like managing their separate account assets. Like for them, private credit is a really attractive type of asset class to participate in. Generally throws off pretty steady income and attractive returns. And so what the rated feeder does is a type of structure that's really designed to provide favorable regulatory capital treatment to an insurance company by structuring the vast majority of their commitment as a rated debt instrument instead of as a straight equity commitment. So at its most basic, if I were to structure a rated feeder for a regular private credit fund, and I was trying to attract a $100 million commitment from an insurance company, I would structure it so that 90 million of the commitment is actually structured as a commitment to make loans, and the other $10 million is just a regular equity commitment. And then I would go out to a rating agency, like any of the rating agencies, it could be S&P or Moody's or Fitch or Egan Jones, and they take a look at that structure and the nature of the feeder's relationship of its debt portion to its equity portion. They actually issue a credit rating on that debt. So then when the insurance company comes in, every time I would otherwise call capital, I'm calling for like a loan for 90% of it, an equity portion for 10% of it. That drops down into the main fund, just like the loan proceeds and the capital. From the main fund's perspective, that looks like any other feeder fund contribution. So um, those have been a popular tool for the past, increasingly popular, I would say, over the past like 8 to 10 years or so, really have taken off. And now you're starting to see a lot of evolution in the rated feeder space with some people wanting to take only the debt portion, some insurance companies really only wanting the debt portion, which leaves the manager trying to separately raise the equity portion. And the insurance company is actually wanting to tranche out the debt portion itself so that they get to the right like risk adjusted return and ratings profile that they're looking for. So those are really starting to resemble like a traditional securitization vehicle. Pivoting to the sort of retail side for a moment, what you're seeing there is like managers really pursuing distribution to a mass affluent investor base that has traditionally been underserved by alternative investments. You see a big uptick in the launch of things like BDCs and interval funds and tender offer funds that are designed to accommodate like private credit and other types of illiquid private equity, venture capital, and certain types of real estate strategies. And you have sort of your household name brand, like big sort of traditional managers raising hundreds of billions of dollars in capital in those channels. You have the rest of the market reacting to that, and middle market managers saying, I'd like to participate in that as well. At the same time, you have a regulatory environment that's increasingly making it easier for managers to launch those products and to have them co-invest alongside their private funds without a lot of the traditional regulatory hurdles that have made that more difficult. So you see a sort of a positive regulatory win there and a lot of interest in pursuing that type of easy distribution where, unlike a traditional closed end or institutional fundraising where each investor has their own separate negotiation in order to close them, once you can get those types of products onto a distribution platform, they're essentially distributing themselves and they don't need to be individually sold to the various investors. What you're really doing there is like trying to make sure you're lining up the right gatekeepers and developing a partnership with them in order to launch those products. But because of that, right, you have your insurance companies, your rated feeders, and your retail distribution taking off. There's just a lot of different players kind of coming into the space through different methods beyond your traditional closed-end funds that were then marketed only to institutions.
Not much to add there. I mean, that's spot on. I would just say that 4 years ago, we didn't have one rated feeder in our portfolio. Now we have over a dozen. They're fairly popular now. It's an interesting structure. One to, put a lot of requires a lot of attention, as these notes can, trade, unlike a normal fund, the notes can trade outside of, the fund, from one entity to another. So keeping track of those people, who are currently owning the notes, doing capital calls if it's a, closed end, rated feeder, um, are interesting because you're calling for both the notes and the equity. But Heather hit the structure spot on. We've generally seen it as either 5 or 10% equity, and the rest is notes, usually an A, B, and C note, say at 10, 8, 6 or something like that. We don't deal with a lot of retail product at the moment. But again, our clients are mostly middle market, you know, private private funds. So, but everything that I have worked in my past 20 years of fund admin on interval and BDCs was, spot on. It hasn't changed. It's very popular.
Appreciate that. So when managers are looking to launch this type of strategy, or I'm going to say, or expand their product offering, right, to a new group of investors where they haven't dealt with before, are you seeing, any thinking or thoughts around, any leverage or financing or other types of things, sort of to bridge the gap on capital calls to assets or things of that nature? Just trying to see if there's anything else in the structure that really hasn't been talked about.
I would say getting evergreen funds, there's definitely some leverage involved usually. Um, Such an interesting business in the fact that leverage for leverage purposes. Um, but the the funds themselves, I find, are putting the capital that they have through subscriptions to work pretty quickly, um, and maintaining, a pretty good pipeline of deals. Um, Again, as you sort of move past direct lending, which is a little bit longer of a gestation period in the deal pipeline, working with some more of these um, constant financing need strategies like specialty finance, um, you are, you don't really, depending on how much investor money you're getting in, the leverage can be minimal.
Thank you.
I mean, as you move away from a traditional closed-end fund too, like a traditional subline is a bit trickier, right? Because traditionally what's being underwritten there is the actual investors in the borrowing base
Right.
and their credit worthiness. And if you have a fund where people can be coming and going, it's just a bit of a different exercise for a lender to underwrite.
Right. So we talked about some of the operational challenges, sort of where the market, the LP demand is, sort of as we kind of look at where our current state is and kind of looking forward, the next few years, kind of where do we see, I'll say, this space evolving into, and even as we think about compliance on some of these things, right? As managers, if they traditionally offered a closed-ended vehicle to institutional LPs, and now we're talking with private wealth or insurance companies, the SEC priorities just came out for 26, and there's a lot of the same themes about compliance and retail, right? Because it's going to be the focus going forward, because it's where the pipeline of LPs may be for some. So really just turn it over to each of you to kind of see where do we see the demand, the market, and kind of what we're going to see in the future.
I mean, there's a lot of advantages for managers who can pull off launching an evergreen credit fund, whether it's an institutional product or a retail product, because that's permanent capital in many ways, and it's accretive to the value of the manager's business itself as well. So with an uptick in like manager acquisition and M&A activity, I think this is something that people also view as like a really positive thing to have as part of their platform. I think when you've traditionally launched, series of closed-end funds, you often have like the same investors that are re-upping each time you launch a new vintage. And the one thing I would be cautious about is making sure that your investors who've traditionally been in your closed-end funds are actually willing to invest in an open-end fund, because sometimes we've found that even loyal LPs may not underwrite closed open-end investments if they're traditionally people that are only making closed-end investments. So before you would engage in some sort of like, if we build it, they will come type exercise with the next like series of a fund, it's always good to go back to your kind of original anchor, relationships and see if they're amenable to doing an open end structure. And if so, then it would have good momentum to launch. But you'd want to kind of confirm that before building that for an institutional product, because we have found that like that's a very like investor by investor specific sensitivity. Some investors really like that they can make a single commitment, and if they want to adjust their allocation to you, they can do so by the redemption process. But others are more hesitant if most of their experience has been on the closed end side. I think that will change over time, but it's an important thing to note before just plunging headfirst into launching an evergreen fund, because there are a lot of advantages to having them. They are very attractive, but you also want to make sure it'll be a success.
Yeah, good point. Um, I would just add that I'm a firm believer that private credit and private equity sort of work together here. Um, and we see both. We see both closed-end credit and evergreen credit. Um, and in this market, and in the market that we've had for private equity has been interesting over the last year and a half, as IPO activity has basically evaporated. But private credit doesn't rely on that, and they're sort of self-amortizing funds, given the way their maturities work, and there's always the possibility of refinancing. So I think it's a great tool for managers to have both. And again, we're seeing both closed-ended credit, if you can do it, depending on the institutionality of the investor base that you're going after, versus the more sort of high net worth, ultra high net worth family office maybe likes the um, evergreen structure, with the liquidity terms that are favorable for them and their underlying beneficial owners. But it's just really a nice balance to the market right now, as lenders are tightening, as I mentioned before, on their credit. So someone's got to fill that void. And that's what we do in this, in our industry, right? The alt industry fills a lot of voids. Um, and it's not particularly reliant on any particular market other than interest rates, and just the nature of the product supports an evergreen structure. So I think as you're out to the market, and you'll find there's who you're going after will really dictate what style of fund, whether structure, open or closed, evergreen or not, um, will be attractive. At the end of the day, the underlying tradecraft and discipline that you have in house stays the same. Um, and you will sort of structure, as you would in the debt space, structure something to meet investor demand.
Well, thank you. And as we reach the end of our time here today, I just wanted to say thank you for both you, Heather, and Michael, for joining us today and sharing your experiences and your knowledge about the industry. We appreciate it. Thank you.
Yeah, happy to help.
Thanks for having us.
Thank you.
Thanks, Matt.
Thanks. Bye bye.